Hello, welcome to Taxinator. This session is regarding Control Foreign Company and its implementation in Pakistan. This part 1 video explains the basic concept of CFC and what was the purpose of inventing this mechanism. So the first question that arises to your mind is that what is a CFC regime? Before we dig into it, the first thing to understand is how a resident person is taxed in any jurisdiction. So since we're going to discuss how it's going to be taxed in Pakistan, we will discuss the definition of a tax resident person as per the tax laws of Pakistan. So, who is a resident person as per the tax laws of Pakistan? A person is a resident person for tax purposes in Pakistan if a person is present in Pakistan for 183 days or more, or a person who is present in Pakistan for more than 120 days or more in a tax year, with total presence of 365 days or more in the past 4 years. So here there are two conditions. If any person qualifies under either of the two conditions, he or she shall be treated as a tax resident for Pakistan. For clarification, citizenship does not play a part in the definition, and any person from any nationality shall fall under this definition. Being a resident taxpayer obligates you to pay tax on your world-over income. Any income earned in any corner of the world shall be subject to tax in Pakistan. That is where a tax avoidance scheme is devised to avoid this tax on world-over income. It starts where a resident person, let's say in Pakistan, incorporates a company offshore in a jurisdiction where there's a zero or lower corporate tax rate. For Pakistan, the favorite destination is UAE, where there's no tax. So how does it work? A resident person in Pakistan forms a company in UAE and makes investment in that company, which is passive, that is with no active economic activity, but with investment in securities, property, debts or IP rights, in return of which the company in UAE earns passive income in the form of dividends, royalty, income from property, capital gains or interest income. Now when company earns this income, normally an investor would want the profits in the form of dividends, which would pass on to the shareholder. When that dividend moves to the resident person in Pakistan, that's where the tax is paid in Pakistan. But no dividend is paid to the shareholder here, and the incident of tax is likewise deferred and avoided in the jurisdiction where actually the investment was made from. So where does that profit goes? That profit is spent by the resident person as company expense on his leisure trips all around the world in the streets of Champs-Élysées or Oxford Street, which means no tax is paid in Pakistan, and the tax base of Pakistan eroded as well. This is the whole scheme devised to defer the tax and get tax-free profit. So, on the whole, what is the takeaway of this scheme? Number 1. It erodes the tax base of the source country, that is, in our example, is Pakistan. Secondly, income from that investment is tax-free or is taxed at a lower tax rate in the other jurisdiction, in our case UAE, where there's no income tax. Thirdly, the tax incident which is invoked when dividend is paid out is deferred, so the law cannot touch that money. Lastly, the shareholder gets to spend that profit in any part of the world, and that too tax-free. This is where the CFC regime comes in. First introduced and invented in 1962 by US, followed adoption in 1972 by Germans, 1980 by France, 1984 in UK. China, after achieving a significant economic growth, adopted the regime in late 2008. However, in 2013, OECD included the CFC in the BEPS Action initiative to fight base erosion and profit shifting. So how does CFC work? The first step of CFC is to identify these corporations in which a resident person holds shareholding. and the shareholding threshold limit is set, for example, 10% or more. Depends on each country. For example, the BEPS initiative of OECD sets the minimum threshold at 50% holding, both legal or economic. But it depends on each jurisdiction. Second step is that those corporations' income consists of passive income. The aim is not to target income which has actual economic activity in the other jurisdiction. However, in some jurisdictions, the regime targets specifically passive income of the CFC, irrespective of the ratio to its total income, and in some jurisdictions, the whole income of CFC is taxed if passive income amounts to more than a certain percentage of CFC's total income. So it depends on jurisdictions how they target it. Corporations qualifying these conditions are termed as CFC, that is, Controlled Foreign Company of the resident person. Now, as corporations, that is CFCs, are identified, let's discuss how the CFC regime taxes the profits. Let's assume a resident person in Pakistan has 10% or more shareholding in a CFC in UAE, and that CFC in UAE earns significant passive income in the UAE. However, the CFC pays no dividend to the resident person. This is where CFC is invoked, and the regime taxes the proportionate income of the CFC during the year on the basis of percentage shareholding of the resident shareholder. So even if the dividend is not paid, the tax on that income is paid in the year in which it is earned by the CFC, and subsequent dividend actually paid in any year shall be exempt to avoid double incidence of taxation. So CFC does not wait for the dividend to be dispersed. That is how it acts like an anti-deferral mechanism, where deferral of dividend income will not affect its taxation in the source country. However, foreign tax credit on that income paid in the other country shall be adjustable against the CFC income. This is how the whole mechanism acts to avoid tax deferral and base erosion of the tax base in the source country. Pakistan has recently adopted this regime under Finance Act 2018 by introducing Section 109A in the Income Tax Ordinance 2001, which is basically part of the BEPS action plan, for which Pakistan is also on board. This part was intended to give a general understanding of the CFC concept. In the next part, we will discuss how the CFC regime is introduced in Pakistan in detail. Thank you for watching this video. Follow us on our social platforms for updates regarding taxes in Pakistan. See you in the next video.